A video on CNBC which is about why oil prices can turn negative. Now that's an interesting topic because how can the price of something be negative, and that to oil, which is so expensive in normal times? How can it be negative? Okay, so let's watch it, and I'm sure we'll learn a lot of economics of the oil prices by watching this video. This is an advertisement.
Kan je ook niet meer wachten? Live Sport is terug op Ziggo Sport. Met Formule 1, maar ook La Liga en de Premier League. Gratis voor Ziggo-klanten. Dat is het plezier van Ziggo.
The coronavirus pandemic caused an economic shutdown unlike the world has ever seen. The US economy, which runs on oil, came to a halt as people followed orders to remain in their homes and not go into their offices. On April 20th, the effects of the pandemic forced crude oil prices in the futures market to sink below zero and into the negative territory for the first time in history.
Oil prices plunged into negative territory. The price settled at, get this, negative $37 per barrel, which is down 305%.
Okay, so it has happened already. Okay, so that's one good information here, that the oil price has become negative in past. So it's not like it's going to happen, it has happened. I don't know what's the current status, but I think a couple of months back it was negative.
Meaning people would pay you today to take their oil off their hands.
When West Texas Intermediate crude futures fell into negative territory, it really shocked the global economy. This was an event that was unprecedented. And before it happened, people didn't think it was possible. It doesn't really make sense when you try to wrap your head around it. How could you pay somebody to take oil off your hands?
It's no secret that the US economy...
That's true, right? How can you pay somebody to take your oil? And that can only happen when keeping the oil or storing the oil is very costly for you. And in fact, that's what is happening, right? The countries are not equipped to store oil. So they are paying money so that somebody else can take it from them. Yeah, so that's interesting. So let's...
economy still runs primarily on oil. It's been America's largest source of energy since surpassing coal in 1950, with an average of 20 million barrels consumed per day. It's also an industry that, along with natural gas, supports more than 10 million jobs nationwide and contributes to 7.6% of the GDP.
America does rely on oil in many ways. It's about 90% of the energy that we use in transportation, and it's more than a third of the overall energy that we use. In fact, it's probably going to stay that way for a lot longer. The Energy Information Agency administration predicts that going out to 2050, it's still going to be over a third of the energy that we're going to use.
So how was it possible for oil to reach a negative value? And what does it mean for the American economy? To understand what happened, it's important to know how a futures contract functions.
So the futures market is a way to bet on the future price of a certain commodity. So that can be oil, corn, wheat. Those are all examples of commodities. And the way that a futures contract works is it's tied to a delivery date in the future. So you are locking into a contract, both a buyer and a seller, and you are agreeing to delivery of that commodity on a certain date and at a certain price. So the way the oil market works is it's divided between the physical market, which is the oil itself, as well as the financial market. The financial market is made up of various futures contracts that are tied to specific grades of crude, as well as specific delivery dates.
Different types of oil from all across the world are traded by barrels in their individual marketplaces. But two futures contracts serve as the major benchmark for oil pricing. Brent crude trades oil from the North Sea in Northern Europe, setting the standard for international oil prices, while the West Texas Intermediate, or WTI, trades a specific grade of oil traded in Cushing, Oklahoma, that serves as a domestic benchmark for oil prices.
A refinery might have a contract with a producer and say, we will pay you the Brent price, or we'll pay you the Brent price minus the transportation costs, or that it's all subject to negotiation. And those two are well known. It's a shorthand, if you will, and a lot of times other crudes are priced off of those crudes because they're well known. The quality is high, and it has a long track record.
Similar to most traded commodities, oil prices rely heavily on how much of it is available on the market. In other words, supply and demand.
Oil, like just about anything else in the world, is determined. The prices are determined by a willing buyer and a willing seller. And so that means that as demand goes up, more people are buying it, the price will typically go up if supply stays the same. And vice versa, if supply suddenly increases, then typically the price will go down if demand stays the same.
The demand is determined by how much oil is needed at any given moment. Due to its crucial role in the economy, high demand has often been associated with a healthy economic growth.
Historically, oil demand has moved with the economy of a country. It's been very tightly tied because almost all transportation comes from burning oil, and a lot of other industrial processes use oil. So when the economy is humming along strongly, the demand goes up. And when you have a recession, the demand goes down.
On the other hand, supply is usually determined by the producers, who have control over its output. Historically, the Organization of Petroleum Exporting Countries, otherwise known as OPEC, has played a crucial role in determining the supply. OPEC currently has 13 member countries, including Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela as founding members. However, a lot has changed in recent years, as the US surpassed both Russia and Saudi Arabia to become the world's largest crude oil producer since 2018, thanks to the rise in production from American shale fields.
Essentially, these countries and OPEC, everyone is competing for market share. Everyone wants to produce more for their country, but also the optionality to export it to another country, and especially growth regions such as China, Asia.
Being an investor or a producer in the oil industry means keeping an eye on this fine balance between supply and demand, as well as the geopolitical events that could threaten the industry.
Never forget about geopolitics and the impact it can have on the oil price, because that can be that X factor of why oil may have a big premium or a big discount to fundamentals that you see in supply and demand. It's because geopolitics introduces other risk factors.
A historic drop occurred on April 20th, 2020, with the US oil prices on WTI dropped by almost 300%, trading around negative $37.
What happened with oil in terms of the negative pricing in April with the futures contract was rather unprecedented. We have seen negative prices before. For example, last year we were talking about negative natural gas prices in Waha in April 2019. But that's more due to processing or field issues, not what has happened specifically this time with the COVID-19 and the price war.
Oil prices had been under pressure since January as China battled the spread of COVID-19. When the pandemic finally reached the rest of the world, demand took a devastating hit.
People started talking about the demand going down 2 or 3% instead of growing by 1 or 2%, as had previously been expected. But then by the time it got to the United States and all over Western Europe, the forecasts were very different. And at the trough, we probably saw demand in April bottom out down 30%. So we've never seen anything like this, certainly in the last 40 years, since world oil markets have developed.
To make matters worse, a price war erupted between Saudi Arabia and Russia in early March, after OPEC and its allies failed to reach an agreement on deeper supply cuts.
Oil saw its worst trading day in 29 years yesterday. Both WTI crude and Brent crude lost nearly a quarter of their value, and the S&P energy sector ended the day 50% off its 52-week closing high as Saudi Arabia launched a price war against other key producers.
As supply remained steady while demand struck record-breaking lows, the petroleum industry quickly began running out of storage space to put their oil.
Cushing plays a very big role as one of the main hubs of that commercial storage. And Cushing, at the time of the negative contract, was around 70% full. And what was left was perhaps already committed. So that was a huge issue because Cushing plays one of the main roles in pricing the WTI contracts.
As the delivery date for WTI grew near and investors had nowhere to put the oil, they soon began a massive sell-off, prompting an unprecedented crash into the negative territory.
WTI is special in a way because it's so tightly connected to physical oil. And so if you're holding a contract for WTI, you're expected to take possession of the oil.
What was happening was the buyers who had bought a futures contract, which meant they had responsibility to take delivery of the oil, recognized that that storage was filling up and they had no place to put the oil and they didn't want the oil. And so they wanted to get out of the contract. Usually they can get out of the contract by getting somebody else to take the oil instead at a positive price because oil is a valuable commodity. But there was nobody who wanted to take that oil, particularly because it was located in an area that was producing way more oil than they needed, and the pipelines to move oil out of that area were completely full.
The historic drop quickly sent shockwaves through the U.S. financial market. The Dow plunged by over 1,200 points over the following 2 days, and brokerage firms like Interactive Brokers reported taking a $109 million hit to cover its customers' losses.
It was kind of what happened in 2000, where we were wondering if the computers could roll over. Some of the trader computers couldn't even handle the negative. They weren't set up for a negative. So you can imagine the disarray and the surprise, that some traders faced the next morning when they looked at their margin calls or what they owed based on the severity of this drop.
However, experts point out that although the event was unexpected, there is no need to panic.
It was not unforeseen. The exchange itself saw it as a possibility ahead of time. They actually discussed what to do if that were to happen, reprogram their software and so forth. And at least one major media outlet reported on it, a week ahead of time before it happened. Also, some other products have gone negative in the past, things like natural gas. So I think it's important to put it in perspective that while this had never happened with oil before, it was just on one particular instrument, the WTI. It was just for one day, and it was seen as at least a remote possibility ahead of the time that it happened.
It was very few contracts. There was very little trading at those prices, and the price very quickly rebounded into positive territory. Now, prices are very low, so that is a reflection of the fact that demand dropped tremendously and supply was not able to drop as quickly. Since then, we have seen actually production in that area of the United States drop drastically and start to catch up with the drop in demand.
The price of oil has steadily recovered since the event, jumping by nearly 90% in May and registering the best month on record for West Texas Intermediate. However, the petroleum industry is still reeling from the effects of the pandemic. Major companies like Chevron, Exxon, and ConocoPhillips have all announced deep production cuts, and Whiting Petroleum, once a large player in the oil industry, became the first major company to declare bankruptcy in April. The impact will likely be more severe for the U.S. shale industry, that is often in heavy debt due to its high production costs.
We might not see the price go negative. I think that was just a quirky event, but we could see the price drop down into the teens or $10, and then we would see a real devastation of the shale industry. As it is, we're still likely to see a pretty big devastation. A lot of the shale companies are going to go bankrupt. Because they've been betting on prices being $50 or $60 a barrel, and that would take a really massive rebound in the economy to happen.
Just like any other sectors of the American economy, the health and the success of the petroleum industry now rests on how quickly and safely the U.S. can reopen for business.
We know that when the economy gets back up and running and people feel safe and
Alright, so we learned a lot of things from this video, right? It started how things unfolded. It started with the corona crisis that happened in China. It was very unprecedented. Nobody had thought that time, in February or January this year, that the crisis will spread over to the rest of the world. And nobody had expected, right? And countries were simply not prepared for that. And what happened was that the virus spread across to many other countries. So countries went into lockdown, so there was no demand for the oil. And when there is no demand for oil, obviously you have a stockpile, right? You have a lot of oil, plenty of oil, with you, right? There are few countries that are producing or heavily relying on oil, and they have oil, but they do not have the storage capacity, because in a normal economy you would simply supply the oil to the other countries, and then you have you can then use your storage capacity optimally. But when nobody is buying from you, then how do you store the oil, right? The extra production, how do you store it, right? There is no supply chain available to supply it to other countries, and that's the reason why oil price became negative. Now it's also still a bit difficult to understand how come it can be negative. I mean, it can be zero, that's possible, but how can it be negative? I mean, why would somebody pay you to sell something, right? And that's possible actually in the financial market, if you take into account the financial market. In the video we learned a bit about the future market, where the contract is that at a future in a future time point there will be transactions. There is already a contract that somebody is going to buy from you at a certain price, but you simply do not have storage capacity to buy things, right? What will you do, right? You do not want to buy and then you pay a price for that. So, and that, in that sense it becomes so the value of that contract basically becomes zero, but it has a price, so you have already paid for it. So if you take that into account, it's a bit complex to understand how they're related, because it's commodity and you have financial market, but you combine both, it can happen that the price of the commodity can very well become negative, and that's exactly what has happened here. And it happened only for a couple of days, right? It rebounded to a positive number now. So now oil price is positive, but it's very, very low, and the reason being that the demand for oil is simply not there in the world, and I think this is going to be a big problem for all the oil companies. Let me show you something interesting. So the biggest oil company in the world is Exxonmobil. Okay, and let's see Exxonmobil stock prices in Yahoo Finance. You will see that there is a downward slope. It has let's see the stock price of the oil company, different oil companies. Let's see the trend. Let's see the trend in the last 6 months. You see there's a gradual decrease, and then is slightly increasing over the last few weeks, but you see the drop in the price, right? So that's what's happening to Exxonmobil. It's one of the biggest oil company in the world. British Petroleum, okay, maybe just BP, or maybe Shell. Royal.Shell. Let's see. The price looks like in a 1 month period it's fine. In a 6 month period, yes, it's also more or less the same, like Exxonmobil, right? There's a gradual drop and then it's stabilizing a bit. Yeah, so oil companies are being hit very hard. So the stock price has gone down, and if it continues, right, if it continues couple of years, then many of these oil companies will go bankrupt. They simply won't be able to maintain the operational cost, and oil companies are capital intensive. They need a lot of capital to be operational, and that is very difficult. That will be very difficult for them. So many of them, I'm sure, will go bankrupt. Well, most of the industry during this period are suffering, but oil industry is one such industry which is suffering perhaps the most after the travel and tourism industry. Alright, so something we learned today, right? How the commodity price can be negative, and that to oil, right? I mean, if it was sand or something else, then it would have been, things would have been different, right? Because these are not very costly products or commodities, but oil is a very costly, is a very pricey commodity, and in a normal economy, right? Everybody is talking about, everybody talks about the oil thing, price of the oil, right? If you have oil, then you are rich, right? The Arabic countries, the Middle East countries are rich because they have oil, right? So oil is a very, very expensive thing for many countries, and in oil import is very important for many countries, and that countries spend a lot of money on that. But turns out that in difficult situations like this, it carries absolutely no value. So it's something very interesting actually, right? How it plays out. Yeah, so we learned something different tomorrow on economics or finance. Okay, so if you are new to this channel, you can subscribe to this. We'll be live streaming a lot of these videos. We'll be discussing a lot of these interesting things about economics and finance, personal finance and things like that, and we'll talk about even other things like politics and so on. Okay, thanks.